Depending on the path you take, there'll be different, debt structures, right? And then there's also different risks. If you also own the property already, there are also loan products available to where you can tap into the current equity and give rehab funds to repair a property. How do I get enough capital to purchase this property, right? You may hear the terms hard money, private money, bridge loans. At the end of the day, it's short-term money for rehab that needs to be paid back within, say, less than 2 years. So short-term money for rehabs and long-term money when the property is functional and move-in ready.
Is it a good idea to, say, tap into home equity for either investment property or primary home to fund a down payment? Because we talked about, maybe you got less money out when that last BRRRR. So you're looking at where else can I pull the equity out? And this could be for down payment or also repairs. We were talking about a lot of people. Part of the risk of managing bigger projects is you may need more capital for doing repairs, and maybe another property is a source for that. So what kind of guidance would you give about people who are thinking about pulling equity from another property for a new investment?
So I guess for the down payment piece, whether it be a home equity line of credit or equity from another property, I would say depending on the path you take, there'll be different, debt structures, right? And then there's also different risks. So people also might even do credit cards. So I would say, whether it's a home equity line of credit or it's a credit card or equity from another property, just understand the risk you're taking and then factor in that new debt into your overall numbers. That way, as you deploy that capital into a new investment property, the numbers should include that initial debt to say, hey, this the cash flow, and there's still cash flow when I factor in the payment for that line of credit or the payment that I have to make for the equity that I pulled out from another property. Include that number. Let's not be naive about it. Include those numbers. If you are purchasing a property that needs rehab, you can get the loan that includes the repair money as part of the initial loan to purchase a property. If you also own the property already, also loan products available to where you can tap into the current equity and give rehab funds to repair a property.
Right. And then just when you're saying understand the risk means that that money that you're pulling from another source still has to make sense in the overall return on the investment. So you can't like exclude it. So if you throw in, let's say, $20,000 of more capital and that like kills the ROI of the deal, it's not a good deal if you have to do that. If you're not getting the income on the other side, it doesn't make sense to leverage your home in that way. That's where you're going.
Yeah. So, for example, if somebody does like a traditional cash refinance, they're going to have a monthly payment and have the money in their hand, right? Independent of them finding a new property yet. Line of credit, for example, it sounds like a big credit card. They have the money available. They aren't making any payments yet until they deploy that capital. So, literally understanding the mechanism of how you're using that money. And also, too, the line of credit, it might be a variable rate that changes, but you're not paying anything until you use that money. So, yeah, so it doesn't hurt to have multiple options to how to purchase a property.
Now,
So you can,
if I mean, I guess it's a tough question because you're saying something that maybe some lenders may have not even broached with their clients. It's like, do you have the money? All right, cool, we're closed. Like, so how much do you coach? You put your other hat on, your clients around that risk? Because technically, you can make money off doing the loan, but then they lose money, in a year from now, and then they're mad at you because they're in a bad deal over their head. What kind of coaching do you give people on the front end about this kind of understanding the risk?
yeah. So whenever there's, say, a loan product, like for example, a rehab loan, it's a riskier loan product, but it's designed for you to have the funds to create equity in the property, right? Also know too, rehab loans, the max term might be 2 years, right? So there's risk as far as getting the project done in a short amount of time and then paying it off. And then the client will know what the estimated funds are needed before they even submit their offer. For that way they can evaluate the available capital. Or also too, most of the time I tell investors like, hey, if they need additional funds, they have to change the question to how do I get enough capital to purchase this property, right? It might not be their own money. They may bring in business partners. So just thinking differently, like, I need funds. it doesn't really have to come from me. I may have a good deal on paper where the numbers are awesome. And I can tell you a lot of people want to invest in real estate. So if they reach out to their network, they may be surprised. They may find the funds available from like a relative or a coworker who have the same mindset that they want to invest in real estate and build generational wealth.
No, that's a good point. That probably is a whole nother topic. But that I think for some people, adding in a partner or two may make perfect sense. In terms of, is there still kind of like hard and soft money? We call it rehab loans, but some people may just think of that as like hard money. And then I've heard some people call it, oh, my loan is soft.
So
Oh.
I'll break it down into two formats. Short-term money is typically money needed for rehab. And you may hear the terms hard money, private money, bridge loans. At the end of the day, it's short-term money for rehab that needs to be paid back within, say, less than 2 years. And then you have, I call it more standard for properties that are move-in ready or turnkey, like a traditional, say, 30-year fixed option or 7/1 arm, where it's amortized over 30 years, and it's more what you kind of used to as far as the terms. So short-term money for rehabs and long-term money when the property is functional and move-in ready.